And tomorrow it's earnings season with Citi, Wells, and JPM all reporting before the bell. But a note of caution perhaps from Jefferies, which fell yesterday on a revenue miss, saying fixed income trading was cut in half amid, quote, challenging market conditions. Does that set the tone for the other banks? Bob, what do you think?
No, it does not, and I'll tell you why. We're talking about trading activity. There's only a half a dozen banks that do trading activity. Most banks, including the big super regionals, they don't have trading desks. You want to look at loan growth, which has been trending higher, better. Not just corporate loan growth has been doing better, but even credit card growth has been a little bit stronger recently. That's certainly a very good sign. Interest income has been trending higher. Okay, we could get the yield curve a little higher. I agree on that. But overall, the trend is moving in the right direction. And finally, the reserve releases are lower. That's out there. We got to watch that. But credit's very good right now. So for most banks, outside of the trading activity, don't worry about that. Most banks are fine. When was the last time, Kelly, you saw the bank ETF, KBE, at a new high the day before earnings start? They usually start selling off. Not today. New highs.
That's true. Delano, do you like it when you see, names or sectors run up into earnings?
It could depend. I think Bob makes some great points that, especially for the banks, I'm focused on, what the loan growth is happening, especially for the banks that have obviously large retail and commercial books. And that's the biggest thing I'm looking at with these banks. I think one of the other areas is really that, from a long-term perspective, what the fintech players are doing. I think I have a proportion of banks that I like when I'm looking at, my asset allocation. It's a bit smaller, but I'm really focused on those fintech players as well. But for the banks, they've been one of the biggest beneficiaries of the rebound of the economy. And as we move to interest rates rising and continuing to rise, I think that the momentum continues. So I'm still going to keep that exposure, Kelly.
Yeah, Courtney's favorite banks are whichever ones are based in Ohio.
Always, of course, Kelly. Anything that's based in Ohio. Ohio against the world. Have you seen those T-shirts? I've got a couple of them.
I'm thinking like Fifth Third, some of the rest of them, looking for some strong regionals. All right, let's move along and talk about Mattel getting an upgrade to buy today. The shares are up 4%, but they're only, I say only, they're up 20% over the past year. MKM Partners is bullish on their upcoming product lineup and say they can expand profit margins even with rising costs. Mattel also has licensing rights for upcoming films like the new Jurassic Park, Minions, and Top Gun, among others. That could all boost sales. While they've been up 20% over the past year, rival Hasbro is only up about 3%, so significant underperformance there, Court.
Yeah, there's a lot going on with both of these companies. But if we focus on Mattel, because that's what MKM Partners is focusing on, they're upping their price target, and largely because they're saying they see the opportunity for net sales growth just from those licensed products associated with the movies you mentioned, the Jurassic Park, the Minions, and the Top Gun franchises, to basically hit above the mark that they're projecting. Plus, then you also have these relaunched brands like Fisher-Price, Thomas, Mega, the American Girls. They've at least been on what they call a sustainable uptrend. And yes, there definitely is inflationary pressures, and that can hurt profit margins. MKM is actually projecting it could hurt them by about 350 basis points. We're talking about higher resin costs, higher shipping costs. However, they sort of feel like that's already priced in, and that's sort of a level that's appropriate with the stock. And we're seeing this note move the stock to levels we haven't seen since about October for Mattel. So a lot going on here as the company works really to sort of mobilize intellectual property and these brands into sort of whole communities of what's going on around the movies themselves.
Yeah, just wait for the metaverse. Delano, I know you think there are better names in consumer discretionary. Where would you be a buyer?
So I think one of the areas I actually like Mattel versus Hasbro here, because as Courtney mentioned, those inflationary pressures are big, but their biggest line, one of their first lines in their investor deck was talking about how they've increased the amount of e-commerce sales as a point of sales in totality. So I think that's a big thing here. And I think other areas, I still like the e-commerce play. We're still seeing other consumer discretionaries being hit hard. And I think those will rebound. But Mattel here has done a great job. That licensing play is important. You're seeing all the other content providers, not just product and toys providers like Netflix, moving to that licensing play. And I think there's going to be a bigger area here as consumers are still in a very strong position as of right now. So I do think that's a good play here, Kelly.
Oh, great. All right. You're loving it. Load it up. Fill your boots. Let's get to Hertz now. Despite all the meme mania that helped pull it out of bankruptcy, the shares are down 25% since they resumed trading on the NASDAQ back in November. But today, Oppenheimer is bullish, initiating shares that outperform with a $31 price target. By the way, the shares are a little under 25 today. They're citing improved cost structure, an under-levered balance sheet, and newfound discipline post-bankruptcy as catalysts for a rally. We know rental cars saw a huge spike in demand during the height of COVID as people wanted to avoid public transit, Bob, maybe moved places where they needed those cars. The prices are still really expensive, but should we expect the trend to persist or not?
Well, with the acknowledgement that everybody wants to go out, and so this is a recovery play to a certain extent, I am not so sure about this. I rented cars from Hertz for decades. They were my go-to car company. There was a major problem, though. They were expensive compared to everybody else. And I eventually moved on to Enterprise and found them just as competent as Hertz was, but, cheaper. Now, I don't know why. Maybe I'm paying too much or getting the wrong cars, but that's what I saw. Now, I laud them for getting back out of bankruptcy. I laud them for getting their expense structure down. But this is as competitive as the toy industry is, and this is a very difficult business to operate in with very high overhead costs. So I'd be very, very cautious about these kinds of companies.
Delano, they got kind of the buzz they were looking for with the Tom Brady ads last year and the Tesla fleet announcement, but now it seems like investors are saying, okay, you gotta show me something more than that.
Exactly. The prices run up so much, and now it's getting to areas where you have to understand if this is the price that you want to pay for a stock that did just come out of bankruptcy, obviously. And obviously, they've done a good job in the cost reduction. They've restructured where it was $500 million of cost reduction. I think they've closed a lot of their low-margin sites. But, investors have to kind of look at the valuation here. That's why I've stayed out of the stock, because there is a move towards, more use and sharing of, obviously, and this is a rebound play. But I'm just looking at the cost, and I just don't think it makes sense at this point, Kelly.
All right, and the share's getting only a mild bump on that news today, up about 1/10%. And finally, the dating stocks. Match and Bumble were in the red last year as the pandemic crimped demand. But Goldman and Piper both assuming coverage of Match with bullish ratings today. Both firms are optimistic on long-term growth for online dating in a post-COVID world, citing Match's broad portfolio of apps, including Tinder. Little less love, though, for Bumble. Goldman upgraded the shares to a buy. Piper isn't sold yet. They initiated Bumble with a neutral rating despite their quote, valuable women first approach. Match in the red today, not even, I think they were rallying earlier, and Bumble is up about 1%. So without delving into everybody's dating life, Bob, what are your thoughts on the stocks?
I'm tempted to say swipe left, but no, I think what you want to do here is what seems to be obvious is I was surprised when I looked at this. The penetration rate seemed very low, and I'm surprised because you'd think the whole world, if they're interested in dating, would find these kinds of, between them, they own 50% of the business. You'd think that's pretty obvious to do, but it seems like there's a lot of room to grow here. I look at this comment from Goldman. This sounds very creepy to me. The lines between social and friend discovery and dating are blurring, and we see a path for incremental monetization opportunities in the year ahead. This is a little creepy. So the lines are blurring between friending people and dating them, and we're going to find some way to mush it all together and turn into what?
Of course, everyone who showed up to these new neighborhoods and towns, they just want friends. My town has like a new neighbors, a group, but basically these platforms could be more than just dating, I think is what Goldman's trying to say.
Right. Absolutely. Absolutely. I think there are, right? There are other specialized apps just for that. So why not? If Match already has data and they're already matching people location-based and, certain likes, why couldn't you just be friends too? I don't know. Maybe there's an opportunity for that.
But can you imagine, Delano, if I'm trying to tell my husband, like, no, I promise, I'm just trying to meet friends. He's like, why is this on your phone?
That exactly right. And they are doing so. So I know Bumble, I think, is one that started a social club or is trying to start a social club in New York. I would swipe right, I think that is on Match, and swipe left on Bumble. I think one of the areas that Bumble's struggling is the growth, and it's a very competitive space, especially when you're talking about how short this time span that people will spend on these apps. And I think if you look at what Bumble did, they're growing a little bit on the Bumble side. They're not growing as much on their other platform, the Badoo side. So I think that's an area of concern, and that's why the stock has been hit so hard. But Match is a conglomerate that owns a lot of different platforms, Hinge being one that's really popular, I believe. And so I think that's where I would lean for it. But it's a tough area.